Ever watch a trade tick exactly 1 pip below your stop loss, take you out, and immediately shoot in the exact direction you predicted? It feels like your broker has a button specifically designed to wreck your account. But nobody is watching your screen. That reversal is just pure mechanical market plumbing at work. We call that a liquidity grab. Major banks and hedge funds aren't trying to steal your $50. They actually need the volume generated by your stopped-out order to fill their own massive positions. Once you understand how these institutions hunt for volume, you can stop acting as their bait and start tracking their footprints. If a massive fund wants to buy 100 million units of a currency pair, they can't simply hit buy at the current price. There aren't enough sellers. Forcing that order through would cause massive slippage, driving the price up and ruining their own entry. To get filled cleanly, they need a concentrated pool of sellers. And biggest costers of sell orders are hiding right below obvious retail support levels, disguised as stop losses. This diagram shows how that plays out. You have a massive volume block, the institutional buy order, waiting to absorb hundreds of tiny sell stops clustered just beneath a support line. The algorithm intentionally drives the price down into this zone to trigger those stops, giving the institution the exact liquidity it needs to enter the market. Because of this mechanical need for volume, classic retail patterns like double bottoms aren't actually strong floors. They are highly visible liquidity pools waiting to be swept. To trace where the big money is actually going, you have to filter out the noise. Minor 5-minute price swings are irrelevant. You need to map the macro structural shifts. This chart maps an upturn. Every close above a previous high is a break of structure, confirming institutional intent to push higher. But when price fails to make a new high and breaks below the recent low, a change of character, it signals momentum is reversing. Tracking these precise structural breaks allows you to isolate the true macro roadmap and ignore the micro fluctuations engineered to trap retail traders. When institutions finally deploy their capital, the market moves so fast it literally leaves gaps in the price action. This 3-candle sequence shows a fair value gap. When the first and third wicks don't overlap, it leaves a void. Below it is the order block, the institution's massive entry point. Price is drawn back down to fill the gap and tap this block. Professional traders don't buy blindly in wide support zones. They wait patiently for price to revisit these specific, high-precision footprints. Even with a perfect order block, institutions won't buy if the price is too high. They use a 50% equilibrium rule, acting as wholesalers who only look to buy in the heavily discounted bottom half of a trading range. This diagram shows inducement. Algorithms engineer a minor support node right above the true entry point to lure eager traders. The market offers a slight bounce to build confidence, then aggressively crashes through early stop losses to access the real order block underneath. If you don't see a clear cluster of trapped liquidity sitting directly in front of your chosen entry zone, your order block is the liquidity. Standard retail strategies require wide 50-pip stop losses just to survive normal market volatility. By basing your entries on specific single candles, you can tighten that risk down to just 5 pips. This bar chart compares the math behind those two approaches, a concept known as anti-fragile sizing. On the left, a wide 50-pip stop limits you to a small position. On the right, shrinking that stop loss to 5 pips allows you to multiply your position size tenfold while risking the exact same percentage of your total account balance. If both of those trades run for 50 pips of profit, the retail setup makes a standard 1% gain. That concentrated 10x position turns the exact same price movement into a massive 10% return. You don't need a perfect win rate to succeed with this framework. The goal is to survive inevitable drawdowns mathematically, letting a single, highly leveraged, asymmetrical return erase a string of small losses. Attempting to execute trades with ultra-tight 5-pip stop losses is mathematically impossible if you're dealing with wide spreads or sluggish execution. That requires an institutional-grade environment. The FXNX platform is specifically built to protect and execute these high-precision, smart money setups, offering 0-pip spreads and the rapid execution speeds necessary to catch narrow entries. Stop providing liquidity for the banks. Download the FXNX position sizing calculator and open an account today to start